Welcome to the deep dive. This week, we're jumping headfirst into the Forex market. Quite a challenging week, actually, from June 28th to July 4th, 2025. Our mission, like always, is to get past the headlines, pull out the really important insights, the strategic lessons from all the sources we've gone through. Think of it as, well, your shortcut to understanding how all this complex economic data and global stuff actually interacts. Okay, so let's unpack this. The core tension this past week, it felt like a real tug of war. On one side, you had this undeniable U.S. economic resilience, especially in the jobs numbers. But then looming over everything was this shadow of geopolitical risk, specifically that critical trade deadline. And this conflict, it just created some really complex volatility and honestly some surprising reversals.
It really did. It's fascinating watching those forces wrestle for control of the market narrative. We're going to dissect, I think, the top 10 most impactful events using our RACS score, the real-time composite impact score. That's our way of sort of measuring the reaction across different assets, figuring out where the real impact was, and, well, what the market prioritized. It was quite telling. What jumped out immediately, I mean, right away in our analysis, was how that July 9th tariff deadline just became the dominant force, just completely overshadowed things. President Trump confirming those potential tariffs. Well, was it 10% up to 70%? And the stalled talks with the EU, with Japan, over auto tariffs, it just created this pervasive risk-off feeling everywhere. And this specific risk, it kept implied volatility really high, across currency pairs. And it actually encouraged people to take speculative short positions against the U.S. dollar, basically as a hedge.
Right. So what's the implication there? I mean, what does that actually mean? It sounds like this trade tension, it acted like a kind of gravitational field, right? Just pulling the dollar down, stopping it from holding on to gains, even when other news looked good. It basically overshadowed the fundamentals, which, if you're watching the markets, that's a pretty big deal.
Exactly.
Yeah.
The key takeaway here is pretty clear. When you have a big binary geopolitical risk like this front and center fundamental analysis, it kind of takes a backseat. It's just noise. So for traders, the main thing was just solid risk management. Cut your position sizes, maybe think about options for hedging, buying puts on USD pairs, for instance, and definitely avoiding big directional bets until that cloud of uncertainty lifted.
Okay, here's where it gets really interesting, though. We absolutely have to talk about the U.S. non-farm payrolls report. That was July 3rd. This was, hands down, the biggest shock for a lot of people, but ultimately it turned out to be a trap. So the numbers. The U.S. economy added, 147,000 jobs in June. That smashed the forecasts of 110K. Unemployment surprisingly dropped to 4.1% when everyone expected 4.3%. And the previous 2 months got revised up, too, by 16,000 jobs. Sounds amazing, doesn't it? But here's the kicker. Wage growth. It was weaker than expected, only up 0.2% month over month.
And the immediate reaction. Classic USD surge. Just textbook. The dollar index DXY, it shot up to 97.35. USD JPY broke right through 145.0. We saw a big realized interest rate shock. That's our measure for how much yields jump right after US 2 years, popped up 10 basis points instantly. And our sentiment reversal score for the dollar showing that mood swing. Very high. And this is the crucial twist, that strength just evaporated. It was incredibly short-lived. Within 24 hours, the USD lost pretty much all of it. Our cross-asset correlation drift metric, which flags when things that usually move together start diverging, that was notable too. The S&P 500 actually rose along with the dollar in yields. That's not your typical risk correlation. Broke the pattern. And the post-event volatility shift, how much choppiness spikes after news, that was way up too, estimated plus 80%. Huge swings. Yeah, really hammered home the point. This NFP surge, a classic breakout trap. The best strategy, really, was to fade it. To sell into that initial data-driven pop in the USD.
It just shows you really vividly that when markets obsessed with a bigger risk, like those tariffs, even strong economic data gets treated like, well, noise. And if you connect this to the bigger picture, you see how the other reports, even the significant ones, they either just echoed the main story or got completely lost in the shuffle. Take the US ISM Services report. Also on July 3rd, it did return to expansion, 50.8. Good business activity, new orders. But employment actually dipped. But the key thing here is timing, right? A positive secondary report, even a pretty decent one, it had almost no impact. It came out just 90 minutes after NFP and still totally under the shadow of the trade stuff. You really needed to know where the market's focus was.
That's such a critical point. Yeah, the timing. And speaking of the U.S., that ISM manufacturing report on July 1st, that seemed to point directly at the trade impact, didn't it? It stayed in contraction, 49.0. And what really stood out from the sources was businesses explicitly saying significant tariff uncertainty was the reason.
Exactly. So the strategic insight is pretty direct there. That report confirmed the negative hit from trade policy. And that split, the struggling manufacturing side, the clear victim of the trade war versus the more resilient services side, that's a key macro theme you need to watch. Really important for assessing recession risk going forward.
Right. Now, moving over to Europe, the Euro area HICP inflation data, the preliminary numbers on July 1st, they came in exactly as expected, bang on, 2.0% headline, 2.3% core, right on the ECB target. So the lesson there. Not all big data points cause waves. When something key comes in exactly as forecast and it doesn't really change the central bank's thinking, it often becomes a non-event. Don't chase the expected stuff. Good point. And what about in Asia? Japan's Bojie Tankin survey on the 30th of June? That showed surprising resilience, didn't it? Large manufacturers at plus 13, though the outlook for September was a bit cautious.
It did. But look how the market read it. It shows how domestic data gets filtered through that global lens. Markets saw strong Tankin data as just another reason to sell USD JPY, reinforcing that USD weakness theme. Not really as a reason to buy Japan itself. It just fit the existing story.
Ah, interesting. And similarly, Japan's industrial production on the same day. Pretty weak, right? Only up 0.5% versus 3.5% expected. And again, blamed on U.S. tariff pressure.
Yep. Another secondary report getting lost in a busy week. The lesson is really about filtering. You, listening, need to focus your energy on the events that can actually shift the whole market narrative. And then beyond the pure economics, you had these other currents playing a role. The Russia-Ukraine escalation, June 28th, 29th, those large-scale attacks. It just highlights a constant truth, doesn't it? Geopolitical risk is still fundamental support for gold, XAU, USD. Even when other things like higher U.S. yields might normally pressure gold down, that background instability can put a kind of floor under the price. Yeah, good point. Then we also heard from Fed Governor Bostic, didn't we, on July 3rd. His comments were quite telling. That wait-and-see approach, mentioning the uncertainty, businesses delaying decisions because of the tariffs, that really helped explain why that dollar rally after NFP just fizzled out so fast. Absolutely. Yeah. It underscores why listening to central bankers is so vital. You need to understand their reaction function, how they're likely to respond. The Fed basically signaled, look, we're not just going to react mechanically to strong data when there's this massive uncertain risk hanging over everything.
Makes sense. And finally, we can't forget the month-end, quarter-end stuff, right? June 30th. Portfolio rebalancing.
Oh, yeah. Those technical flows from big institutions, they can cause significant, sometimes really weird, short-term volatility. The caution there is always be a bit wary trading on the very last day of the month or quarter. The moves might not reflect genuine sentiment.
And they can reverse sharply the next day, which can sometimes offer opportunities, I guess, for counter-trend folks. Okay, so pulling this all together, what does this week really tell us? The NFP report was a huge shock, no doubt, but it kind of just exposed the real dominant theme, didn't it? Which was that fear about the U.S. tariffs deadline. The market is clearly prioritizing geopolitical risk over the economic fundamentals right now.
Precisely. That's the headline. And the successful strategies this week definitely mean reversion, fading those spikes, especially around NFP. That worked well. Volatility-based strategies, too, given the choppiness. And just generally following the trend of USD depreciation driven by that trade risk. The biggest mistake, you saw people making it, was getting fixated on one data point, like NFP, and just underestimating the power of the main story, the tariffs. That's how you get caught in a bull trap for the dollar.
Right. So looking ahead, for you listening, priority number one has to be risk management around that July 9th tariff deadline. It's a binary event, huge volatility potential. So maybe think about reducing leverage overall, widening your stop losses to allow for bigger swings, or maybe using options to define your risk. Also, maybe consider focusing on cross-currency pairs, like EUR JPY or GBP JPY. Sometimes when the dollar is being pushed around mainly by politics, crosses can help you isolate more fundamental differences between economies.
That's a good point.
And finally, you need to be ready to reevaluate the USD trend entirely. Depending on what happens with the tariffs, if a deal gets announced, that whole risk premium holding the dollar down could just vanish. You could see a strong rally. Or if tariffs go on, the dollar could fall a lot further. The strategy needs to be reactive. Wait for the news, see how the market confirms it, then trade the momentum that follows. Don't try to predict it.
Absolutely. And this whole week, it really raises an important question, doesn't it? In a world where these geopolitical factors seem increasingly able to just outweigh core economic data, how do you think this shift fundamentally changes the way we should approach understanding global markets? Something to think about.